Ken, in particular to those stories and factors I just mentioned weighing on the market, do you think slowing global growth, whether caused by trade or not, is already priced into U.S. stocks?
I think so. It's hard to be certain about such things. But the fact is that if you take, for example, today's IMF forecast numbers, the downgrade in their estimate is 0.2%, which is a change so small that it's much smaller than the likely margin of error around that. And people right now are too prone to look at kind of the little things and extrapolate them into big things. I think that's true. I think where we are is that we've climbed back up the very steepest part in response to what I've told you before was a V-shaped move off the bottom to the early December levels. And now we're going to be in a more grinding pattern moving forward as we move kind of back up to the early October levels.
Ken, how much do you think hinges on trade deals actually getting struck this year, be it between the U.S. and China, what happens with Brexit, some of the other deals that are being worked out right now? How key is that to how investors should be positioned for 2019?
I've said for a long time that the biggest point about Brexit is to finally get clarity, and what I hope happens is that we finally do. Relative to the other ones, they're actually smaller, and I've said this for a long time, if you actually look at them as a percent of global GDP, regardless of their outcome, than people want to talk about. And therefore, while they have a positive and or negative outcome, it's less than what people want to, again, extrapolate. We've been in all of last year making mountains out of molehills kind of a view, and this is the year, I think, where we reverse that slowly over time.
Ken, what do you make of the earnings season here in the U.S. so far? I guess there's been differentiation from individual companies in a way that we haven't seen so clearly for the last few quarters. It's been the same sort of trends floating or sinking all boats. Does that mean it's a stock picker's market once again?
Well, quite clearly, the beginning of the year quite clearly has not been a stock picker's market. I think it gets to be more so as the year progresses. But I think the most important differentiation tied to the earnings and earnings announcements is the tendency to talk down for future estimates for future earnings so that managements can exceed them. We play this game off and on regularly over the course of this economic expansion where earnings in aggregate come in stronger than expectations, and then management talks them down a certain amount to make it easier for them to beat them in the next cycle. And I think that's what we will be doing, and that'll contribute, I think, to that jagged seesaw pattern that I envision for the next few months of stocks moving up with downward wiggles. And likewise, right here, right now, I think Davos in the next couple of days will contribute to that as folks at Davos in a kind of a corporate bureaucratic mode will talk things down, which is what they normally do at Davos.